What's up traders, welcome back. You guys have been asking me to make a video revealing my live trades together with the breakdowns. So this video is going to incorporate my thought process utilized with respect to analyzing the higher time frame toward executing on the 1 minute time frame. So let's get it. So we're on the daily time frame. So the current candle is the previous day's candle. So that's the current price action that you're going to have at hand. So when trading ICT, you always want to inquire yourself, what is the price trying to reach for? Which will always be liquidity or inefficient price, which means rebalancing price. So let's go through the order flow. The first thing you need to do is to identify the range. One way of doing it is finding the 50% of the equilibrium price point of the price that took out both sides of the market's liquidity. When that happens, it's going to form a range with premium above and discount below. So on our price, we have buy side taken right here, and for sell side, we have this low taken here. So the reason why this low is valid is because this swing right here took out the previous swing's liquidity. So now the liquidity is going to move to the next short-term low that forms, because as you can see, the current low did not take any previous liquidity. So now the liquidity is resting on that low. But this doesn't mean that price cannot go below both of the swings, because the lower swing is like some form of a trap move. So we wouldn't want to go back there to release the people who are trapped there. By the way, if you don't understand institutional market structure, it's in this book right here, in case I don't make a video about it. So now that we have identified our liquidity runs, we have to draw the 50% of the equilibrium price point from the high to the low. That's going to give you a premium and discount ranges. So when you're in premium, you look for sell setups, and when you're in discount, you look for buy setups. So let's look at the order flow. We are coming from a liquidity sweep in discount. We had a market structure shift, and after that rebalancing the fair value gap same time, which is our second model on the lower time frame. Remember, price is fractal. We also have the volume balance that you have to note, which is the gap between those two candles bodies. So that gives us confluence, and you can see we had a perfect reaction on those levels and expanding higher. So we are price trading past the order block that took out the liquidity on the sell side, which is our first model or our entry setup on the lower time frame. So when you see something happens like that on a daily time frame, that gives you directional bias, because you're going to expect price to react on that level and push higher, because you've seen that on the 1 minute. So that gives you bias. So right now that put us above the 50% level, which is premium. So inside of that premium range, we are also inside of a fair value gap. So now this is the day when I had to trade. I also saw that we have closed above the 50% of the fair value gap. So that means that it's more likely that we're gonna close the entire range. So now the next level that I see that we might reach for is the fair value gap's high. So now on the lower time frame, I'll be looking to target that level. So on the lower time frame, subconsciously, I'm gonna look for buys to target that level. So that in itself, it's also bias. So let's look at the lower time frame. So we're on the 5 minutes. So what's the number one rule? Always check your economic calendar. So you can see that during our trading time, we did not have any high impact news. So now we're gonna use time and price for manipulation. So now the second rule is identifying and highlighting your trading time, which is also the equity open at 9:30 AM Eastern time. So during this trading day, my bias is bullish until we get to the blue level that we have identified. So I'm going to be scouting for every possible technical reasons to take a buy setup towards that blue daily level. Because price is fractal, based on my current price action, I saw that we had a liquidity run on the previous swing. So where does the open liquidity reside after the stop hunt? Is this one right here, just like we did on the daily time frame. So we are using the last stop hunt rule. The previous swing took out liquidity, so the next low that form is where the liquidity is going to reside. So that's a short-term low, and the previous swing is an intermediate term low, because it has a short-term low on the left and on the right of it. But you can refer to the book that I suggested. By the way, if you want the soft copy, I can send it to you for free. Just DM me. So let's continue. So we had a liquidity run exactly after our trading time started. So what gave me confidence and confirmation that we are not going to go for the lower swing? Always divergence. Nasdaq is running for stops while S&P 500 is trading above the same level. That's why I always tell you guys that whatever you're trading, always have another correlated pair or future index that you can use to confirm the divergence. So let's continue. You know that my execution time frame is 1 minute. So let's see what happened inside of here. So we're on the 1 minute. We already have a liquidity run with divergence. So what's next? So now we have to start looking for our entry model. So we have an order block right here that took out the liquidity. So when you trade above that order block, that's your entry level and your stop goes below the swing. If your psychology is not strong enough to enter while the price is pushing past the candle, you can always wait for a retest, or you can use the second model, which is the fair value gap model or the ICT 2022 model. So we have a fair value gap right here with a market structure shift. So you're gonna set your buy limit or take your buy execution when the price comes back inside of the fair value gap and target the opposite swings. You can target the low hanging fruit, which is the current swing, or you can go for the entire range, which is from your entry to the blue daily level. Don't forget that on the daily time frame, that's a fair value gap high. So with price pushing up, forming a third leg and leaving a fair value gap behind. If you miss the first two entries, there's your third chance. So you can see after that, there's no other setups towards the level. So you can see that the fair value gap is also inside of a breaker block, which is that green candle that formed before price went down to take out liquidity. So here is something that I haven't mentioned in this channel, which is the midnight open candle. You can go to your chart on a daily basis and mark the midnight open candle at 12 o'clock midnight. What you're going to use that for is for confluence. You can see how the price reacted on that level. When you're bullish, you're supposed to buy below that level or buy at that level. And if you're bearish, you're supposed to sell above the level or sell at that level. The whole idea is based on the power of 3, which I will demonstrate in the future videos. If you've come this far, thanks for watching. I'll be showing you guys the trades that I took on the following day using the same trading plan. If you find this video useful, please like and share your thoughts in the comments. Maybe someone has the same thoughts or questions. Otherwise, subscribe for more content. Until I see you next time, Das Vidania.